We need $5,700 of retirement income starting at age 57. In today's video, we're going to explore what I think is an interesting case. I've got a federal employee who wants to retire in just 4 years at their minimum retirement age of 57. And they've got some complexities that they need to address, including potential reductions to FERS pension benefits or postponement of those benefits, as well as the impact of drawing down a retirement portfolio maybe earlier than they had anticipated or would like to. Also want to explore building out a retirement income worksheet, as well as jumping into our retirement planning tool, just to kind of show you the probabilities and what the foundations of a financial plan like this look like when we're kind of coming up, within a very short period of time, trying to address a transition into retirement. So stay with me throughout the video. Hey guys, I'm Justin. I'm a certified financial planner. I've been working with federal employees for almost 20 years. And what we do is we create custom investment strategies and financial planning recommendations to help you meet your goals, whatever they may be. So let's get back to the topic at hand here today. Now, I'll give you a little background here. I've got Joe and Betty. Joe is a 53-year-old federal employee. He's got 21 years of service. Wants to go out in 4 years, like I mentioned, which would give him 25 years of service at his minimum retirement age of 57. Betty is 51 years old, and she currently works in an administrative role in the private sector. She likes what she does, and she wants to keep working as long as she really can. Joe's income looks like this. He's a GS-13 Step 8, and he's making around $143,000 a year. Betty makes around $50,000 a year. So collectively, their household income is a little bit less than $200,000. Let's take a quick look at the balance sheet as well so we can set up our financial plan. They've got about $10,000 in savings. They've got about $450,000 in a TSP for Joe and $150,000 in an IRA for Betty, which was a collection of these old IRAs that we consolidated and brought together in one account. They also own their home, values about $450,000, and they've got a mortgage against that house, about $65,000 left on that. They plan to have that paid off to coincide with Joe's planned retirement date at 57. So in 4 years, that mortgage debt should be wiped out. Other than that, it's a pretty clean balance sheet. We've also discussed taxes, insurance, and estate planning as part of our financial planning process. I'm not going to get into those in the video today. We're going to stick to the retirement plan that we really want to discuss. So as always, we love to start these things off by creating a retirement income worksheet. And to do that, the first step is to think about how much money you might need to spend within retirement. Joe and Betty have already done the heavy lifting on this. They came to me and said, look, we think we spend about $5,800 a month. It includes everything but taxes, and it does not include that mortgage that we're talking about that's going to drop off. So they're thinking about what they're going to spend in retirement if it was today without the mortgage. So we'll have to incorporate taxes back in when we start talking about their income sources. Now, at the beginning of the video, I said we need $6,500 at age 57. We got to that number by adjusting what Joe and Betty told me for inflation. So $5,800 in 4 years will be a little bit more than that. It actually turns out to be about $6,500 if we use a 3% discount rate on inflation. That's step one. That's what we're working with in terms of retirement expenses. Step two, we need to figure out what those income sources are going to look like so we can compare them against our expenses. The first one on the list is, of course, the FERS pension. Now, Joe's been a career federal employee. He's got 21 years. He'll have 25 when he goes out as MRA. He understands he's leaving some money on the table if he goes out at 57 versus continuing to hang on for a few extra years, but feels this is probably going to be the right time for him to make the move. Of course, nothing is set in stone. We're just kind of laying some foundation here. So we can take a quick look at what that pension might look like, and you can do the same for your pension. We need the years of service, we need the multiplier, and we need the high 3. In this case, we know that the years of service will be 25. His multiplier will be 1% because he doesn't meet the 62 with 20 years of service. And his high 3, we're going to guess around $150,000. He's probably going to have some pay raises between now and the next 4 years. So we don't know exactly what the high 3 is going to look like, but 150 gives us a pretty good ballpark to work with. So if we run the numbers out, that gives us a pension of about $37,500 a year. And that's a gross pension without any reductions, which is something we need to talk about in this video. So one point of clarification. Since Joe is going to be 57 with 25 years of service, he doesn't meet MRA plus 30. He's not 57 with 30 years of service. So if he takes an immediate annuity, which he'll be eligible to do under MRA plus 10, he would have a reduction in order to take those immediate annuity benefits. And the reduction works like this. It's 5% for every year you're under the age of 62. So it'd be a 25% reduction if he took his annuity right away. Joe realizes this and he wants to delay taking these benefits until he turns 60. Which he can, and avoid a reduction because he's got 20 years of service. Okay, so that's part of the thinking here within the retirement plan that we're building out, understanding how that works. Okay, so that's one reduction that they may be able to overcome by by postponing these benefits. Gets a little tricky there. If he does postpone those benefits at 57 until age 60, he won't be able to continue his federal employee health benefits until he picks up his annuity again at age 60, provided that he was eligible at his retirement date. So, you need an annuity coming in order to be eligible to continue with health benefits, okay? So you're eligible to postpone the federal employee health benefits and pick them back up in most cases, just like Joe's here. Now, there's a distinction between postponing and deferring, which is big, which you may need to clarify depending on what circumstances are in your case. Now, this creates a 3-year gap for health insurance, right? So part of the thinking here, and I know we're getting in the weeds a little bit when we're talking about the FERS pension, but Betty wants to continue working until Joe turns 60. She may be able to get on company benefits at that point in time. If not, there'll still at least be additional cash flow to cover what's probably going to be an increased cost when we start talking about health insurance coverage. Okay, back to the FERS pension calculation. 37.5 reductions are going to look like this. So survivor benefit premium is going to come off. That's a 10% premium for a 50% benefit. That's what they want to do. They want to protect Betty with the survivor benefit. Okay, so when we look at taking that 10% premium off the $37.50 a year, that brings the annual pension amount down to $33,750. And from there, additional reductions would be FEGLI if they have it. They don't in this case. Federal employee health benefits and taxes, right? And so taxes are probably going to be around 15-16% depending on how things work out with their total income footprint. We'll need to work on that a little bit more, but 15% is kind of a number we'll ballpark for the time being. Now, just to play devil's advocate, if Joe did take his pension right away, 25% haircut, that $37.5 now comes down to $28,125, and then you take the survivor benefit and all the other deductions off of that. Okay, so we're going to try to avoid that. Other sources of retirement income are going to include Social Security. So both will be eligible for Social Security starting at age 62. They're kind of thinking they want to take it at 65. We're going to work on those numbers and see what makes the most sense here. If you delay that and you take it at 65, that creates an even longer gap, right? So we're already talking about delaying Joe's pension 57 to 60. Now, if you're talking about delaying Social Security from 62 to 65, you're talking about creating an additional income gap where you need to fill with another source of income. So it gets a little tricky, but we'll look at that. Joe's benefit is projected to be around $2,400 a month. That's going to increase with cost of living adjustments over the next 9 years until we get to 62, but that kind of gives us a working number. And Betty's number actually comes in right around $1,500 a month at age 62, just based on both their track records. All right, the last piece of the puzzle when it comes to the retirement income worksheet is going to be portfolio income, right? So we know we got this investment portfolio, and we said it's about $600,000 between the TSP and IRA accounts. Now that's all pre-tax money. They haven't built out a Roth bucket yet, and that's something they could start working on, be part of a bigger conversation when we're talking about their financial plan. But within the context of this simple example, they've got $600,000 in a pre-tax account, okay? And so when you start drawing that down, it's going to be taxed as ordinary income. In our simple example here, we're going to say we can make 7% a year for the next 4 years on those accounts. Now, keep in mind that's a straight line projection. Life does not move in a straight line, but that's what we're working with here, okay? So 7% returns, 4 years, and Joe is continuing to make max contributions to his thrift savings plan while he's still working. That's really where their cash flow is going right now. That's another thing we need to work out. Where is the best direction of funds? Should it all be going to Joe's TSP? Should it be going to a taxable account, to an IRA, or some other sort of tax favored account for Betty? Need to work on that. But for now, we're just going to use this within our projections. So $600K, and we add $31,000 a year. That's going to be indexed for inflation as well, but simplicity here, of course. We could be looking at around $933,750 in 4 years. Okay, so 600K could grow with those contributions. Now, if you take a 4% distribution off of that when we're talking about generating income, we'll use the 4% rule here as our benchmark, as our guide. We know that's all it is. So of course you can take more or less than that. And it's really just a starting point. We're gonna be talking about $37,350 a year in income before taxes, okay? So not too different from what's coming in from the pension at age 60, but we've got this gap from 57 to 60. Just to clean this all up. All right, so we talked about the FERS pension coming in, $33,750 at age 60. We've got Social Security that could start as early as 62, more likely going to be postponed until 65. We've got a portfolio that might be worth about $933,000 at age 57, which could generate somewhere around $37,000 before taxes, maybe a little more, maybe a little less. And we've got Betty, who enjoys her work and her willingness to continue doing that as long as she can until she turns 58, when Joe would be 60. So that adds an additional $50,000 of income to the picture, which is really important here in making this work. So, and we mentioned our after-tax income need is about $78,000 at age 57. So we've got a little bit of a shortfall here, not counting distributions from the TSP. If they take those, there's not much of a shortfall if we're comparing it against that $6,500 a month or $78,000 a year that they need. Okay, so it's kind of a workable plan from that standpoint, but it kind of hinges on Betty's ability to continue working. If not, then we've got an income gap where you're going to be drawing down assets, or Joe's going to be considering finding a different line of work, at least to contribute to the household needs, which he might anyway. That might be part of the plan. Okay, what I want to do now is jump into our retirement planning tool and just kind of walk you through some of the numbers here so you can see. And I'll just show you the foundation here. Of course, we talked about Joe retiring at 57, Betty at 58. They've got a little bit of an age gap there. The retirement expenses we're projecting at that age, $6,500 a month. And of course, their current net worth sets up like this: $10,000 in savings, like I mentioned, $600,000 retirement accounts. We've got the mortgage and then the home property, worth about $450,000. So that's how this sets up. Really, we're just keeping this simple in the tool here today and talking about the retirement plans. Okay, next thing I want to do is jump over to our retirement planning analysis and just kind of show you the probability of success and some of the key numbers here and the assumptions that we're making. And I found this really interesting because I did not expect such a high probability of success. And I'll tell you why, because I have a little bit of a bias towards when we start thinking about taking money from a retirement account early. I'm cautious about that, right? Because things have to go really well in order to do that in terms of getting return on your money and making that last over an extended period of time, especially if you're talking about taking potentially more than 4 or 5%. Now, in this case, this whole plan hinges on the idea Betty's going to continue to work, and then they've got these really strong guaranteed retirement income sources that kick in: FERS pension and Social Security at different ages, of course. But you can see here the probability of success in this plan is super high, right? 98% probability of success. And down here, as we always look at these assumptions in our current plan versus what we can change here and say, what if? So we mentioned Joe retires at 57, Betty at 58, $6,500 in expenses. This is kind of what they're saving now. This is our FERS pension kicking in. We got 2 entries here because one is with COLAs, one is not, because the COLAs don't start until 62. And then I put some other things in here, right? So we said at all costs, Joe was going to avoid taking his pension early and avoid that reduction. But we could model that if we wanted to. And then, of course, if Joe decides to actually continue working, which he may, that alleviates a lot of pressure off the cash flow within the plan as well. Okay, a couple other key things to point out: the asset allocation in this plan. We've got a 2030 fund within Joe's TSP, and we've got another target date fund within Betty's IRA that actually working on the allocations there. It's about a 65-35 split, which we're trying to generate that 7% rate of return. That's kind of what we're targeting here. And then, of course, within the plan, we talked about taking Social Security at 65. We can change this too and see what it looks like if we take it early. You see great probability of success. What does that mean? What I really like to look at within this tool is our cash flows. Okay, and this is where you can actually see what's going on, right? So, we're starting out in the first year's plan. We're still working for 4 years until Joe's planned retirement date here at 57. And you can see the income flows go from over $200,000 down to $50,000 because now we just have Betty's income coming in. And there's a period of time until we get to her retirement and then Joe's pension kicking in at 60. That's kind of going to be the cash flow unless something changes here, if Joe goes back to work or, whatever else we decided. And then, of course, at 60, the pension kicks in. And then at 65, Joe's Social Security kicks in. And then a few years later, Betty's Social Security kicks in. So that's how you can see the income flows change there. And we can drill down on that and show you exactly, what the pension and Social Security numbers look like over time. But that's kind of what's being built into our income flows here. So that's going to be our income flows. And then if we compare that against our expenses, we can see here the first few years, we've got the mortgage, which is going to fall off at retirement. And then that will be paid off. And then we'll just have our living expenses kick in here and go forward. And of course, the one thing that we have to consider, taxability, right? The FERS pension is taxable. Social Security is going to be taxable about 85% of that benefit. We got the pre-tax accounts. Anything coming out of that is going to be taxable. So that's why you're picking up these tax expenses here, okay? So your net flows, this is what we're looking at. This is the shortfall. That's what we're trying to plan for. So about a $49,000 shortfall in the first year, and that stays pretty consistent. It grows a little bit as Betty's income drops off and the first pension kicks in, but it's not quite enough to make up the full difference there. Okay, and it stays about the same until Social Security kicks in, right? And then when that does, that gap drops, and it actually, we actually have a surplus when Social Security kicks in based on their benefit levels. Okay, so that's really interesting to look at. So the stress on the portfolio is really over this, 10-year period, maybe a little more than 10 years here that we're looking at planning for, taking withdrawals from the portfolio. So let's look at what that does to the investment portfolio. Now, keep in mind, these are straight line projections, but you can see over here, this is how we're projecting for things to grow. And this is about, a 7% rate of return, a 6% rate of return. You can see with contributions, this is where we get to at age 57. So close to what I had just on my basic back of the napkin math in the beginning of the video, right around $900,000. And if you're taking $49,000 off of that, that's a little more than 4%. It's between 4 and 5%. So it's a workable number. That's why this plan works at such a high level. So we're still kind of staying in that ballpark. This number grows a little bit, right? So now you're getting up here $70,000, $80,000 coming off of 900K. So you're getting closer to, an 8 or a 9% distribution rate, which is what we want to avoid. But in their case, it's for such a limited period of time. Okay, we mentioned it's like a 10-year period. So you do start to draw down the principal balance, but it's for a short period of time. The straight line projections here, of course, help. If we have a bad year, that's something we need to talk about, and they probably need to make some adjustments to the plan. But that's kind of what we're looking at here. Once the other guaranteed sources kick in, you can shut off or really ratchet down the amount you're taking from the portfolio, and not that much damage had been done. You can see that in the plan here. Okay, so that's kind of what things look like. Now, I think what's interesting here is to take a look at a couple of what ifs. So let's say Betty decides, I'm going to be done the same age as you, Joe. I'm going out. I'm not going to keep working anymore. So she goes at 54. Actually, she'd be 55. Let me fix that. So she would be 55. You can see the probability of success is still high, 88%, which is great, a great number. But you can see how the ending assets, it's about half of what we're projecting. And so the really interesting thing to look at here is you'll see from this chart in the circumstance that we're really drawing down the assets at a much greater level. So again, we're talking about growing up here. It's almost $900,000, but now we're taking out $100,000 a year to start in those first 3 years before it drops down a little bit. So that's a really big withdrawal on a percentage basis. And so you can see the ending portfolio balance. We're really drawing this thing down. By the time Social Security kicks in, you're down to about $600,000 in assets. And if that was going to continue, right, and you mixed in, a bad market year and kind of this sequence of returns snowballs on you a little bit, things could get a little dicey. But thankfully in this plan, they have those guaranteed income sources that are going to kick in and alleviate the stress on that. And the other thing is they're ultimately not spending that much money. And the last thing I'll illustrate is just some of the things that we could look at here. I'm not going to get in the weeds right now, but we could look at what happens if, Joe starts working, right? And how does that change the plan? Or what if he takes the pension at 57, right? And just based on the need for the healthcare, they couldn't find another solution. Those are some things that we can model, as well as the one that's interesting is taking Social Security as early as possible, right? So how does that change the plan? And I'm not going to dig into the numbers with you here, but we'll just show you the probability changing actually goes down a little bit because the benefit is that much lower based on the 3 years. Okay. So in this case, we're actually projecting it's probably better to draw down the TSP assets versus taking the Social Security early. That's something that's important to consider case by case basis. No right or wrong answer there that we can just make as a blanket statement. It really, really depends on your situation. All right. So I hope we didn't get too far in the weeds there. There's a lot of information, a lot of great concepts that we can talk about and cover in scenarios like this. But I think the important thing here to look at is this plan works based on the fact that Betty's continuing to work. And even if she doesn't, it probably still works. It just puts a lot more stress on those assets and the asset management strategy, you know, in those years. It's pretty delicate, right? There's really a sweet spot that you have to hit there. If you have questions, you're working on your retirement plan, your transition out, please feel free to reach out. I'd love to hear what you're working on, see if we can be a resource for you. If you found some value here, of course, please give us a like and a subscribe, and we'll see you next time.